Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody. I hope you had a good Federal Reserve meeting yesterday. Sorry I wasn't able to be with you through most of it, but hey, we're gonna, the real action I always feel is like the day afterwards. Man, Octavius and Uzi are both saying yes. Wow. that fast, huh? Okay. Well, let's go to the charts and try and get into this quickly, huh? Because the real action I always feel is today. If I can find, I've kind of shifted my desktop around a little bit. So oh yeah, see, it opened up on the wrong window. Changed which monitor was the primary monitors. So here we got the treasuries. They moved pretty high off of the initial news, and then during the press conference, it was all down. And in the overnight, we've been down. Here is the non-farms payroll numbers coming through here now. Let's see here. Hold on a second. Because that was a decent reaction. So it sounds like we got a more interesting number than we've been getting in the past, huh? Let's see here. Initial jobless claims 219 versus 230. So better than expected. And Philly Fed Business Index, who are expecting 0, we got 1.7. We have existing home sales later today, 4-week auction, 10-year tips. Bank of Japan decision. So we're on the downside. I don't know if that will continue or what. It's really, really hard for me to say. Sometimes the way that these move after Federal Reserve meetings can be a little confusing. All right, S&P 500, though, they liked it, and they're up overnight. So it's all good. It's all good, right? There's oil doing a little bit better and back above $70 a barrel. Gold got hammered hard, but they're coming back with vengeance, huh? Look at silver too. Copper's looking really good this morning. Japanese yen. So the Japanese yen is falling a little bit relative to the dollar, despite the dollar really falling against most of its peers. But the down here is like the lows of the year in the dollar, and they've kind of been holding it for now. So keep an eye on that dollar, because if that breaks, you might see some wild stuff. Probably good for most of the other markets. So, and then we got Bitcoin finally making it above 60,000 and extending up to 63. All right, so we did get a pretty, I don't know, is that really just because of the jobless claims? Well, I don't want to trade that. I'm not going to trade like the initial move anyways. So I don't think I missed anything, but at the moment, I am not really sure what to make of that. Yeah, the indexes are up pretty big overnight. That is for sure. I think we're going to go with having the market analyzer up here in the corner again. And, I'll just have to keep an eye on the S&P 500 on the other screen. TLT is sad, but everything else is happy. I haven't looked at mine in a bit. I think I will wait until the end of the week to look at it. We can look at Goldman though. How have they been faring since the earnings haven't looked? Trading view. It's kind of funny how that's become my largest position. Okay. So this was earnings. They did get hit pretty hard during that beginning of August trail down, but they recovered that, and it's not as good as I would like it to be. New highs and all, but $500 is okay, I guess. Belligerent. Oh, hey, it's why did you change your name? Okay, well. But it's good. I haven't seen you in a few weeks, yeah. I got a bit to go before TLT gets below my average price, but it's still the loser of the pre-market. That's actually really so your average position is like not as far down there as I thought. It's probably more where this 112.28 half maybe. I thought it was more like here, but that's okay. I mean, so here's the thing. I don't think that treasuries are going to go back down. Like, that's the thing. I don't know if it's the going to be the outperformer, but I don't think it's going to do that. Right? That would be ridiculous. No, probably it's gonna go sideways. That's my thinking. 89.90 until, well, let's see here. Let's compare. Pull up TLT. Let's see here. It's a fund, right? Yeah. $89. Oh, no, it's way down there. You're way down there. No, you did not get 89. Wow, really? Wait, how did you manage that? Because you were investing in it before it was down here, too. You didn't just start picking it up in April. Still, that's not bad. That's not bad at all. That's like a what? 89 divided by, oh, sorry. Let's do it this way. 99.59. %8 win. Still, there was not a lot of time to buy it down there. Unless I'm missing something. Oh, maybe you were buying it down in here. Minimize that. Oh, my previous name was after a character Bruce Campbell played in my favorite show when I was 8 years old. Hercules, the legendary. Oh my gosh, dude. The nostalgia. It all just hit me all at once. Like, ooh, I remember that show. Obviously, though, it was really all about Xena Warrior Princess, right? November of 2023. Oh, of 2022. Yeah. I'm still curious how you got your average position all the way down to 89. That doesn't involve some profit taking, does it? Because that still means that you bought a lot more when it was way down there. You just bought more when it was down there. I almost feel paralyzed sometimes by this conundrum that, like, there's so many choices to invest in and what's actually going to be the best, you know? I really wish I had a better setup to decide which thing I care about the most. Like I've limited it down, but that still puts me down to like 5 or 6 different things. Still seeing the market be pretty active in this area, despite it not being able to get out of this hole and kind of going nowhere. My brother is big on doing like 100 shares at a time, but that makes the initial drawdowns big. You know, the thing that I think is... Okay, so when you see a lot of the things that people say about like how to invest and things like that, and the two biggest factors that you're gonna get is, number one, time in the market tends to beat timing the market. So you do want to put it in now. But then the other thing is that, you know, as you continue to contribute to your retirement savings, those contributions become a smaller and smaller part of the portfolio. So when you first start, you get in and you time it right, and you could maybe double the amount of money that you have in there, right? But then if all you're ever doing is buying and holding, then as time goes on, that timing becomes less and less important. And, you know, that kind of makes the investment game really interesting. I mean, if that wasn't the case, then I think people would have to be a lot more active with their money, right? Now that's interesting. I kind of thought there for a second that they were going to maybe try and make a little bit more of a pullback, but all of the treasuries just got yanked into new lows there, just like that. There was not really a ton of like super strong market volume pushing it that way. It looks like that maybe the yen dragged them lower, but it is extremely heavy. So I was coming in here going, well, you know, it looks like they sold the treasuries after the news, maybe because they think, well, okay, this is dovish in the short term, but it's maybe actually slightly hawkish over the longer term. Like, they might not bring interest rates back down as quickly as we wanted. And so that was like a net overall sell. That, and, you know, Jerome Powell being hawkish in his speech yesterday. But that doesn't mean that we couldn't, you know, maybe continue to push up today. Then we got the news pushed us down. They're not even waiting for the market to recover from that news, and they're continuing to push lower. So it's very, very heavy. Look at that huge iceberg on the offer at 20. So let's reset right there. We'll see if that's the end of that sell meta order and they're able to recover here, or if that's just signs that the order is super, super huge and they're just going to keep selling it. Your AT&T is up over $30 a share? Wait, no way. No way. I don't believe you. Is that for real? Let me look. Because every time I've looked at that chart, I've been like, man, AT&T has not been. You must be way further back. Let's see here. That one is T, right? Stocks. Yeah. Okay, so I have that Warren Buffett. Oh man, really? So I don't know why TradingView doesn't have my little picture in the right spot, but it says that he bought it in like December of 2020-ish. And the whole time I've been like, yeah, and then like, what did it do? It went nowhere, it went down. You bought it when it was at like 30. No, because it's above $30 a share. It's below $30 a share. Oh, you started buying it, but what's your average position? Let's see here, because if you bought it down in these lows, 15 plus $10, so that actually is a pretty sizable gain, just relative to how much we pull back. Actually, you know what I should look at? I should look at Zillow. Oh, Zillow still sucks. Zillow still sucks. I had some Zillow shares, and I think that I had it at like 60. So I think I would have a little bit of a win, but it was probably a good thing to get out of that. Do you think that with interest rates going back down, that Zillow will start to do well again? Maybe I should get back in. Which broker do you recommend for futures trading, and do you know any broker with low commission fees? Based on my experience, the support of AMP and execution speed of Trade-O-Vate are terrible. Well, yeah, unfortunately, I do know one futures trading, introducing broker and futures commission merchant that has particularly low commissions, and their name is AMP. So like AMP and then Ninja Trader have the best prices. And the thing is that they have such a stranglehold, frankly. They have such a stranglehold on the discount market that nobody else can really compete with it. Okay. I use EdgeClear. I don't think that your commissions are going to be as low on EdgeClear as they are on AMP, but they're pretty good. They're still acceptable. And honestly, like a 10-cent difference here and there for people like you and me doesn't really matter. I really like EdgeClear. People there, they know what they're doing. If you have a problem, you get somebody that actually knows what's going on, versus AMP, where it's like I'm telling them literally everything to do because they don't know what's going on. So you get what you pay for. I've been really happy with AMP. When I was on Ninja Trader, I was constantly frustrated because you're limited by the data feed and all these other things. I'm hoping that, a lot of my problems with Ninja Trader, I think, were a factor of them trying to start their own FCM at the time. And maybe as they become a little bit more mature, those will go away, and maybe I can go back to Ninja at some point, because then I would be able to use my Ninja Trader and my algorithms a little bit more freely. You got IBM. Well, now IBM might be good. I haven't looked at a chart in IBM in forever. Yeah, IBM looks amazing. And your cost basis is around 124. Ooh, that's almost a double. That's almost double, my friend. Well, I need to put more. I still have a little bit of cash sitting in there just because I never decided what to do with it. Um, the big one for me, man, rare earth element resources. I really strongly believe. I'm not saying I like really strongly believe in the company, but I think that what they are doing is super important. Like, China has a lock on rare earth minerals right now. Things kind of don't seem to be going very well with China-US relations. And if there was a problem, they would start cutting off rare earth minerals, and it would be a real problem. I kind of wonder if Donald Trump becomes president, if, you know, he starts doing the tariff thing and China starts hitting the rare earths. Well, because that's kind of like their nuclear option, and they were hinting at doing that before. So, you know, that could be a place, and so I want more of it. But I probably need to diversify the portfolio first. But at one point, oh my gosh, it was so high. At one point, it was so high. It was insane. So that was a good play, and I wish that I had kind of taken, you know, I wish I had taken some profits up in there. And then I would have like $20,000 or something to put into it now, probably. No, not that much. I think it was max like 5. It didn't last very long. It's hard for me to remember because that, you know, they've had a split and everything, so the prices on that chart don't match like the numbers that I got when I got it. Yeah, it's not terrible, but it's underperforming. The AT&T. Well, like that's the thing is like, I think I'm setting too high of a standard for myself, because what I really want to be saying is that I had Nvidia, you know, like, oh, Pfizer, and I really you know, I really liked Nvidia, and I was always watching it, but I was always kind of like, well, I don't know if this is the right time to get in or what, because like, how do you value that sort of thing? I just don't know. So. Oh, wow. Yeah, my account is finally over 7,000. My rare earth minerals position is still kind of struggling because after the split and everything. But the Goldman is going really good, and Berkshire is okay. And I have a small silver position. Doesn't really matter too much, but it's been going pretty good over the recent past, so that's cool. You know, this is probably an okay, well, I don't know, kind of, so a lot of it was like, oh, I want to wait and see kind of what happens during the fall months. I've kind of been hoping for a fall. Now's the time. Actually, you know what, I think I do know what I want to get. I think I do know what I want to get. Because if I'm investing for the long term, like, what are the big long term themes that I think are going to be big? Retiring boomers is going to be insane. AI looks pretty strong, although I'm kind of wondering if that hasn't like already become a bubble. Man, they are still going lower. They're not giving me a chance to really do anything on this at all. It's just sell. And I wasn't expecting them to sell per se, so. Anyways, and cybersecurity is another big one. Cybersecurity. Let's come back over here. Oh, no, wait. Did I? No, I didn't. Okay, have to pull it back up again. Let's see here. The only way bonds rally from here is if we enter a recession. The curve will keep steepening, but we should see Any more bull steepening, it's a clear recession signal, says Brannigan Barrett. I think that might be right. Now, I'm not gonna say like I think he's being a little bit too like all or nothing about it, right? Like I think that bonds can do okay from here, but like the chances of them continuing to rally from here and rally the way that they've been, pretty low. I think that it's kind of going to be a little more sideways. Yeah. What am I looking for? CrowdStrike. So I'm not sure if CrowdStrike is safe yet, because like they're probably gonna continue to get sued and everything, right? We need to get on this move, but it's too slow. You know, I'm often frustrated by like some of the largest moves I miss. Some of the largest moves are going to be completely catch you by surprise, right? So I want to come back here. Where are we in the bigger picture? Okay, we're in possible. Well, nah, I don't think I could say we're in momentum. It's definitely a big down so far, and we've definitely breached like levels of last week and everything. I mean, man, we spent so much time around 115 even. But, you know, I think that we would probably have to get below 113 before I would start to say that there's momentum short. You can see the spread steepening though. So that's what I would expect to happen. I think that is kind of more the bigger takeaway from Brannigan Barrett's tweet, and probably the bigger thing is that you're probably going to see the yield curve steepen back out, even if the absolute prices don't move huge. This is the FJ Powell sell-off. Maybe. So let's just so what are you saying? If we lived in an alternate reality where there was no Federal Reserve press conference and Jay Powell hadn't said anything yet, you think that the treasuries would still be buying? Yeah, 30-year dumping delta much harder than the rest. Yes. Because we're steepening. Although it's, I mean, look at the 2s and 10. Steepened out quite a bit today. Although this most recent flush, some of that has reversed a little bit. So, does this mean that, like, if you're betting on a recession, you go for flatteners right now, which is kind of a weird thing to say, I think, because normally it's when a recession is happening, the yield curve steepens out really quickly. But now it's like, well, the yield curve is steepening out either way. This is going to make it very difficult to interpret the larger signal from the yield curve. Obviously, we look at the yield curve primarily to try and judge the order flow a little bit better. Like, as Uzi is pointing out, the delta is selling pretty hard in the 30-year, and the 30-year seems to be leading this move down. Funny enough, the change in cumulative delta in the 10-year is not that big. So this again is kind of why I'm sitting here like, what do I do? What do I do? It just doesn't fit right with me. Like, I think what's happening is in the 10-year, well, actually, no, never mind. That last bar was huge all of a sudden. we just had about 8,000 contracts, so. Like, my issue is at this point, the play is short for sure. But like I'm really not convinced that it's just going to keep going. So, we didn't really take our notes. Let's do that. And that way I can explain a little bit better by those are my notes on my audio production stuff. Okay, so when I look at all of those things, that doesn't scream huge sell side imbalance. The Fed decision yesterday, so far that flow has been sell, but it's very common for us to see that flip back and forth and so forth. Jobless claims slightly hot, that's a sell, but not like a 60K daily move or something like that. And really, for me to want to be going short here, that's the kind of move that we have to be expecting. And then the bill auctions and the tip auctions is maybe actually a positive driver. So let's add in here yield curve steepening. So with all of that in mind, I would expect there to be some market volatility and some moves, but not necessarily so directional. So the directionality of this flow that we've had this morning is taking me by surprise. But that also, I think that there's still a really good possibility that we start to do this sort of like, we had such a strong move and then it turns into a super strong trend up move. That's entirely possible. I don't think I have a clear enough picture. Probably we could have gone short on that though. I mean, obviously if we had gone short, we would have made money on it, but wasn't really the kind of the look that I tend to go for. So you got out before 16. Well, there was a little bit of a pullback there, but I would say that it's about even with the other pullbacks that we've had throughout this downside move. So So somebody, this is something I find kind of funny. I'm here on Reddit, and the first advice animals meme that I see is the Men's Warehouse guy. So you know it's going to be a terrible meme. And he says, Republicans will find a way to spin rate cuts into something negative. I guarantee it. Well, I don't think that Republicans are happy about it being not just a rate cut, but a 50 basis point rate cut. One, because Republicans overall are more concerned about inflation, and so Republicans overall tend to favor higher interest rates just because they're so concerned about inflation. Like I honestly think this is so silly to think about, but I think one of the big factors behind like older people voting Republican is that older people can be just absolutely devastated by inflation, right? Like if you're one of those people that like you didn't really save up enough anyways, you're relying on Social Security and things like that. When inflation comes along, you're so screwed. Okay, so they really hate inflation, and that's one of those factors where like that's why they go Republicans, and then Republicans kind of stay like hawkish. Let's say Republicans are more hawkish. Okay, monetary policy speaking. But then the other thing is that they kind of do, I think, want the economy to not be doing so well when the election comes along. Now, on that part, I think that they're kind of being a little silly. It's already baked in, right? Like the economy can't change that much between now and November. So I don't think that you really have to worry that much about the impact that interest rates are going to have on the economy on the election. I don't think it's as big of a factor as they're all making it out. But that's the whole thing, is that the commentariat is way more concerned about what the interest rates mean for the election rather than what the interest rates mean for where we're actually at in this incredibly unique and complicated location within the interest rate cycle. Reddit is so so yesterday there was a person, they kind of looked like they were kind of saying they were left-wing, because like they said something about, I think they said something about Kamala Harris's tax plans. I think it was there's this thing. Man, I tell you what, the Kamala Harris campaign, their like social media meddling is so obvious, because it's like nothing will happen, and then all of a sudden everybody comes out with the exact same narrative, and you'll see a ton of people on TikTok all saying the exact same thing. So the thing that they're saying on TikTok over the last like week or so has been, well, the economy is actually Donald Trump's fault, that the tax regime that we live under right now is Donald Trump's, which and a lot of these people like misrepresent the history of it. Like Donald Trump came in, he changed the taxes, the tax regime very, very early in his administration. So we went through almost the entire Trump years with his new tax plan, and it worked really, really well, actually. Like the markets loved it, and the economy loved it, and we probably would have been up even more if not for his trade war with China. And that's just kind of a testament to how strong the economy was, that his numbers pre-COVID still look pretty good despite all the chaos that the trade war stuff made. And then, of course, I don't think you can really blame Donald Trump for COVID. Everybody says, well, he handled COVID poorly, but the economy probably would have gotten hurt harder if a Democrat was in charge, because Democrats wanted to keep everything closed for so long. I digress. So this guy, everybody started criticizing what he was saying about it, because he kind of implied that the Democrats didn't have any chance to do anything, which isn't true. They had control of the House and the equal split in the Senate at the beginning of Biden's term. they did pass a law. It was the Inflation Reduction Act. It was not a very good law. And then there was also a stimulus at the beginning of his term, and that's a large part of the inflation and some of the other things that we've been seeing. So he was like, okay, well, if everybody says that I don't know what's going on, where do you go for news? That's what he asked. And so I tried to make a response for it, but there was kind of a theme, and if you go and watch my video on TikTok, there's kind of a little bit of an underlying theme about it, which is you're being really lazy. That's the thing about the news. This news is entertainment, and when you're looking to be entertained, you don't want to go and read studies and multiple data sources and cross-check them against each other and do all this that's like hard work that you do sitting at a desktop with spreadsheets open and things like that, right? And if you're primarily doing it for entertainment purposes, you don't do that, right? If you really want to be informed, I think that you have to do the work. And that's what I see on Reddit, is I see a lot of really lazy people. Like that's the thing. That's kind of like the attribute of Redditors that I seem to catch on to the most. They don't want to have to go and read multiple news sources and verify information, do their own primary research. They want to just go to one cable news channel that they say is correct about everything, and then they know what's going on. And it's, like they want the ego boost of being right, but they don't want to put any of the work in. And that's why I feel like Reddit is so cringe. You scaled in at 17.5. Well, that's an okay. So that last little tick up, that kind of makes this look like more of a reversal, for sure. I'm kind of thinking about doing something myself, actually, because okay. So that kind of screwed the robot up, I think. I put a limit order in and they pulled the price, and then because that price didn't pull, they were like, hold on, wait a second. But then they didn't fill it. So that says to me that maybe actually the market makers do think that maybe they are taking on long inventory at the moment. In the treasury. Because otherwise they would have taken off that one lot. Now that also kind of means it's going to be hard for me to get filled. So. Yeah, uptick. I think that it was too obvious there when I decided to try and get in. See, a little bit of volume has gone off there at 752. Nobody's hitting that one lot either. Oh, okay. Spoke too soon. Somebody hit it. Somebody hit it pretty hard and back. Whoa. What? somebody came in and hit them on the bid with like 10 contracts or something, and then it almost immediately flipped back up. And the treasuries kind of reverted. Okay. This counterflow, it looks really strong, by the way. Like, it has eclipsed the downside. Not the word discounting, but if you don't count the jobless claims news, we've completely retraced in cumulative delta. Yep. Now we've retraced. Don't count that. We've retraced. So, and much faster too, by the way. So this buy flow is really strong. You think that they can make it back up to the cost basis? Let's see. Totally off topic, but when you said I digress, the concept of degassing that occurred in old cathode ray monitors popped into my head, sort of the same concept, but in different domains. Well, are you ADHD? Because that sounds a little ADHD to me. As soon as I want to get in, they start to be like, maybe we're not going to trend so strongly. You got out at VWAP? Well, what, it was 21 VWAP? You must have a different VWAP. This was a lot of volume trading at 20 and 19 out. Like there's 8,000 to take them down at 20, for instance. And a pretty strong uptick at 20 as well. Not necessarily strong in terms of like how much volume, but that when it upticked, the bid was right there very quickly and very strong. So, and they all ticked up at the same time. I think I need to clear the stuff above. Let's do it on all of the treasuries. See, at the moment, based on the volume that we had there and everything, I would expect 20 to become a bit of a liquidity hole. But I'm still seeing relatively aggressive movement. So like that was a pretty strong uptick too into a new short-term high. So while I'm thinking about it, another funny thing that's happening in the politics. So like a lot of people were pushing a video of JD Vance earlier, kind of saying, you know, like people are crossing state lines to do late-term abortions and things, and maybe there should be laws against that or something like that. So those are pretty damaging. This is pretty damaging. You know, the Republicans' biggest problem is with women, and if, you know, you have JD Vance saying things like that, that's kind of going to hurt them. And Donald Trump, I think, has done a good job on the abortion issue, but that kind of could undermine him, right? But I'm kind of wondering if the reason that one is coming out is because yesterday Republicans were talking about a video where Kamala Harris was talking about like literally going to people's homes and inspecting their weapons storage. It's like, if you own a gun, like, you can own a gun, but that doesn't mean that we're not going to come into the sanctity of your home and make sure that you're storing them correctly or something like that. It's just like and like the way that she said it too. It was like, dang, like how, like, could you say it in a more crazy way too? So that's what I think is going on. They're both kind of throwing big salvos at each other because one side kind of did a big one. I don't know who started it, but because I kind of think that those were maybe things that you would maybe have saved for later. But I guess it came out, right? Probably it was Republicans first. Probably Republicans found that Kamala talking about guns, because ever since the debate when she's like, "Oh, I'm not trying to take away people's guns. We own guns ourselves," the Republicans really incensed by that because she was the biggest gun grabber. So I think that they found that, and so then Kamala Harris put, kind of put this JD Vance thing up. So just kind of a little bit of flavor about where we're at. I'm a gun owner. Lol, someone asked her what kind. Oh, that was a good question. What kind of gun do you own, Kamala? That would have been, that would have been a great, I don't know if it would have been appropriate for the candidate to ask it within that context, but that would have been a great question for a debate moderator to ask. Yeah. I'm wondering if, by the way, on this climb back up, the delta has been a little bit stronger here in the 10-year in particular on this long. And I wonder if it's because of, again, that steepening. Because I am seeing the yield curve steepen back out again on this move, right? It was like steep all night, and then this move down, it flattened out a little bit, and now on this pullback, it's steepening again. Although, for my position, it kind of looks like I'm still in this spot where, I get 4 ticks, and I don't really get paid in the micros as much as I think I should. It looks like it's going to turn out, though. It looks like that I'm going to get at least 10. And I was maybe 5 ticks from what I wanted, my position, so I'm a little bit worried about that. She owns a water gun, I guarantee you. I would have sent her right to the shadow run. Oh my gosh. Oh man. You know what just crossed my mind is the headphones feel okay at the moment. I haven't really thought about them at all until now. So it's not really putting the pressure and hurting my head like I was having problems yesterday. I think some of my problems was I didn't really get to eat the breakfast that I wanted because I ran out of eggs. So I was maybe a little bit tired yesterday, but feeling good right now. Okay, so there was a big downtick and they kind of responded to it, and then the buyers hit back with a relatively large amount of volume at 21. But they didn't clear it and tick back up, so. Can you recommend any good material on how to learn and analyze? Yes, if you go to my YouTube channel, there is a video series about order flow, and you go and you watch that. And it might not seem like it at first, because you're probably thinking okay, there's this pattern and you go long, and there's this pattern and you go short, and you're looking for that. But if you really watch that video series, I tell you more than any of these other education materials out there will tell you about the bomb. because I'm telling you the real proven behaviors that you're going to see and can kind of take advantage of. So that are empirically backed, and for some reason other people don't talk. So watch that. Realize that a lot of it really is intuition. Like if you're going to trade the DOM, what you're really doing is you're trying to develop intuition based on what you're seeing, the level 2 and how the level 2 responds to the volume coming into it is really what you want to look at. And so a lot of that is coming in and watching it every day, making sure that you got to understand the flows that are coming in. Why are they trading the way that they are and all of that, okay? But you'll develop that intuition. So I've seen some people more recently kind of saying that like the depth of market is not that useful, and I think it's because they don't really understand those underlying behaviors. So they're just watching the S&P 500 and they're not able to see the pattern to it. So they're kind of like, well, what's the point of the depth of market? It moves around, right? But it really has to do with, you know, how much liquidity is resting, how much pulls when it's the best bid, best offer, how much actually trades, and like, you know, as it trades, do they add more or do they pull, and you know, how does it respond? You're gonna find areas where they don't really want to put up a whole lot. Like you can kind of see it there in the 5-year. You see how they're like only putting a few dozen contracts, either bid or offer at 0.57. Okay, well, it just changed now. Now it's a little bit better. But you were getting that sign of like low resting liquidity. The market maker didn't want to put neither bid nor offer in that location. And that has a tendency to kind of like suck price into it and get them stuck. In that instance, probably something shifted like the Japanese yen. And it probably wasn't the yen because the yen isn't looking so hot right now. But some correlated asset maybe shifted, and that's why they changed their bid. But when it ticks up, it still looks pretty strong because they all tick up at the same time. It's not holding, but the upticks are still looking pretty good. Okay, so like that one uptick 12.59, and the 10-year is kind of meh, right? Like when we were getting really strong upticks, they were putting 2,500 contracts up immediately. This has been a little bit of an area of a little bit of a pullback in moderation. So, what do you mean by jobless claim Delta is out now? Joe Rogan is back to denying the moon landing for real. With Matt Walsh. Wait, is Matt Walsh a moon landing denier? Okay, I'm gonna watch this clip really quick. Oh, I got you. Now we're above the delta from the jobless claims. I got you. Okay. Okay. Matt Walsh says you believe in the moon landing, right? And Joe Rogan is like, well, gosh. Oh, Joe. I watched, you know, there was a Corridor Crew video on that I found so fascinating. Showing all of the things and behaviors about the video from the moon that unless you were a VFX artist and you know, really working in these things, you might not notice. Like the way that the dust falls in a vacuum is very different from the way that the dust falls with air around. And they didn't really have the technology to fake that at the time. And they just go thing after thing after thing. I thought it was, I really like their videos. when they do a good video, Corridor Crew, man, they do a good video. That offer is looking a little menacing and puffing itself up, and I kind of think that's a little weird. Okay, well, the 2000 polls. Like the 22, oh, that's fine, because that was the last swing high. Well, when they were putting it there at 21.5, I'm like, what? Well, let's see. Do they pull, like, if this 22, if they pull like down to 3,000, and then they probably start hitting into it and clear it. Yeah, parallel light. There's so many things. It's a like I always kind of I've never been enticed by the we didn't land on the moon narrative at all. But when there was a time when it kind of started to become a little bit interesting. Like, oh, maybe these people have some interesting things they've noticed that are hard to explain, and we can learn some stuff from them, right? But after that Corridor Crew video, it really came down into like, man, you have to be a complete idiot to not believe the moon landing happened. Trading without a chart always seems so strange to me. You need to be learning it. Well, like the thing though, Erie, is that past price doesn't really tell you a whole lot about future price. Not on an intraday basis. This is so so this came up on a Reddit thread yesterday, and I didn't really get into it, but I kind of want to get into it, okay? Modern day technical analysis is essentially a cargo cult. You know what a cargo cult is? During World War II, the U.S. military had these military bases on tiny islands all over the Pacific. And the natives, would be good friends with these soldiers. And they would get big shipments in, like the planes would drop, planes would land with huge cargo, and all of the people would get all that cargo, right? And then the military left. So what these wow, that really ran. But I think that was because of what I was just hearing on the news squawk. Fitch ratings, U.S. state budgets poised for slower growth after Fed rate cuts. That doesn't seem like something that would cause the market to move, but they sure swept through there. Now we're coming to around my target. So I'm going to play it by ear here a little bit, but here's one possible take profit. Anyways, so the planes would land, they'd get all the cargo, natives were happy, U.S. military left, no more cargo. So what they started to do was they said, well, maybe if we do all of the things that we saw the guys in the military doing, then we'll get cargo. And so they started wearing military uniforms and marching around the island and building radar stations out of, straw and whatnot. We were like making these effigies, all in the hopes that they would get cargo drops. And apparently the U.S. military kind of wants to keep in the good graces of these guys. And so every once in a while they will send them a cargo drop, is my understanding on it. Okay. Yeah. Just Google image. You've never seen that one before? Man. It really is. It's really wild to think about. Like these guys making, like, freaking look at this, like effigies of planes and things like that to try especially these radar stations, right? All in an effort to get the U.S. military to bring them cargo drops. Okay. Modern day technical analysis is exactly the same thing. In the 80s, there were a lot of big funds that made a lot of money off of essentially momentum strategies. Momentum is essentially where they made it. And essentially what they would do is they would go into commodities and, they would look for momentum on a daily basis like a new 50-day breakout or something like that, and then they just get on the trend early and try and hold it as long as possible. And if sometimes those trends in commodities really run, and they made billions of dollars. So retail traders looked at that and said, oh, okay, so you can make money without having to really know anything about the market. Just look at the past price and trade it, and trade momentum, right? Okay. Well, like I said, it's a cargo cult. So it's like you're trying to copy somebody else. You don't actually understand why it works or how it works. Well, how it worked was they were trading long-term trends, like over several months or years, and they were doing it on a whole portfolio. Okay. So momentum is not really a very useful strategy for you if you're day trading. If you are not going to hold a position more than overnight, then that's not going to work. There's too much noise on the short-term basis to really make money from momentum. So it's a cargo cult. And all of these retail traders, they think, well, yeah, but, like quants, they make money from technical analysis, don't they? Kind of, not really. Not what you're doing. So it's a cargo cult. Does long-term momentum not work at all current day? So from what I've seen, that there is a lot of money in that, and so the edge in it has diminished. And what happens now is most time periods, is just kind of the performance is sideways, and then when something bad happens, you do really well. So the momentum strategy is definitely struggling, though. The momentum strategy is definitely struggling. But I wasn't trying to point out so much that it doesn't work anymore, as much as that what retail traders are trying to do is absolutely nothing like what the momentum traders in the 80s were doing. Most retail traders, when they use the term momentum, are misapplying it. I think that if you're looking at any kind of intraday chart, and I'll catch myself saying it all the time too. You're looking at an intraday chart and you're saying, look, there's some momentum. I think that you're kind of like misapplying it. I mean, there are trends on a daily basis and everything, but there's so much noise. There's so much noise. And so on an intraday basis, past prices are not effective at all at predicting future moves. They just aren't. They just aren't. Now, when we get into order flow, there are some edges there in the order flow that are definitely edges, but are super competitive. Okay, so like the big one that we kind of are trying to come in with is that there is a long-term correlation with order flow sign. So if you come in and you look at the 10-year treasury and they're mostly buying, you come back in an hour, there's a very high chance that they're going to still be mostly buying, especially in the treasuries. Because what happens is there's these funds out there like a sovereign wealth fund. If a sovereign wealth fund wants to buy or sell treasuries, the number that they want to buy or sell in treasury futures is absolutely bonkers insane. And it's so much that it will literally take them all day to accomplish that. Okay. So that's why, so you will tend to get like these trends. But here's the thing is that the market makers, they inject a lot of randomness into the price. So you can't necessarily see it in price, but you can see it very clearly in the volume. If you have volume where you're able to say that it was market buys or market sells, which requires the depth of market. So it qualifies as order flow. Right. So that's one that we're kind of trying to take advantage of. And the problem kind of tends to be that by the time you have enough information to confirm that there is that correlation, it is often where it pauses and stops. So, well, man, when we had that big move up, I kind of thought, well, here's like one stopping spot. But I wanted to wait and see if it would cross. And it didn't. It didn't. So I should have gotten out. They went literally to my line to the tick and bounced. Now, I don't think that they're going to come all the way back. I think that they're going to test this line a little bit, and then maybe they'll move back higher. But let's see. For the time being, the long order flow has subsided a little bit. It kind of looks like there was that big rush up, possibly because of that that Fitch ratings story. I mean, that's what I was hearing on the squawk when it happened, and it was really fast, and it looked like a news-driven move. So, like, when that happens, I would expect them to kind of, like, retrace through that whole hole. But, you know, that buying might still be there. Let's see. On the pullback, the cumulative delta handled it pretty well. And they're still buying in the 30-year, by the way. 30-year is actually almost net positive for the day in cumulative delta now. The only one that's still really negative is the 2-year. Where are you looking at? I showed you? I don't know. You have to ask again and be more specific. Oh, darn. Is that like right where my cost basis is? Nah, no way. Hold on. 713. Okay. So I'm not remembering very well, but that is appropriate. That is correct. It hasn't shifted on me. So I was looking at it and I was like, am I really like back to break even? But like when you account for like a 4-tick spread and you know, it's come back, that it's in the same place that it was. So I don't think I have to worry about it too much. Sometimes the spread will kind of move on me and screw me over, and I hate that. But we're okay. We're okay. I don't know if we're really going to make new highs or like make a move towards this open, but they should be able to still be relatively free to trade through this area up here, up to about 23. So of course, it's a little bit it kind of looks like this whole range, like all the way back down to 20, is actually relatively free moving. Oh, where are you looking at? Okay, yeah, sure. So I'm looking right here. Actually, I kind of removed it. So I'm looking right here. Right. This is the primary instrument right here, is the 10-year. Right. So I look at the 10-year, and then my eyes are always right here, and I'm kind of looking at these in my peripheral vision. Okay. There was a little bit of a move in the yield curve that has me slightly nervous. Do you think the bond's going to test the low? Well, I'm not seeing it in the volume yet. I'm a bit miffed, though, that trade only got 10 ticks. What was my max? Oh, actually, I got 15 ticks. Really? Okay, so I just wasn't paying attention very well. 20's acting a little bit better there. Like, I want to see liquidity there and not pulling. So that's a little bit better at 20. But they are clearing it. You know, like, it could turn selling. This is kind of a place where I think you would start to see it turn. Okay. Now it looks like it's going to be at least 5K. Like, wow. Oh, and then they tick up. Curious. My runners haven't been working well for several weeks. I don't know what the problem is. Like, I had all of these moves where it was like I made $20, $30. And then we've been having still relatively big jarring changes in yield and everything. But for some reason, whenever I take it, it doesn't go. Whenever I take it, the micro yield futures sandbag me. And I haven't been very good at getting an optimal location. Like if you think about it, like the spread is 3 ticks. So if you lose 3 ticks on both sides, that's 6 ticks, and you're only looking for 10 ticks, right? Then you're not going to get your fill. That's what's happening to me. Okay. So you see there that quick sweep through 21.5 and 22. That is still, again, like liquidity hold between 20 and 23. And it looks like that they don't have much trouble at all moving through that whole range. But that move up did look pretty aggressive. So feeling pretty good about it. Like, I have to discount it because it's within that hole. But, you know, if they can start getting above 23 again, then I'll feel real good. Nowadays, 3 ticks makes your day. That's so funny, dude. Well, you know what? 3 ticks in ZN would be fine. 3 ticks in ZN would be fine. But in the micros, because of the spread and the commission and everything, like, if I'm not getting 10 ticks, like, I'm start to get really frustrated. S&P 500 pressing below 5,700. That doesn't look good, does it? The volume in the ES is like very much sell. Oh, it's not huge, but about 15,000 contracts. Yeah, S&P bouncing around. I mean, it looks ugly, but that's just kind of like just barely crossing the line. So it's not like dire or anything. This is a place where they might push it a little bit and kind of find a floor in here somewhere. It's not like panic levels yet, but it sure doesn't look good to me. So I'm glad I reset my DOMs when I did, because do you see how we steepened on that move? So be careful with how you're interpreting the flows over there in the 30 here in particular. Because if we're moving up and we're steepening, you're probably going to see a lot of selling in the ZB that might make you think that like we're going to reverse or that it's really heavy or something like that. But it's just the ZB. So watch all 3 of them. Know which way the spread is going and account for that in your reading of the volume. Okay, so they came right back up to that 23 again and are starting to shy away from it, at least for this brief moment. It may be showing some signs of like the low latent liquidity at 22.5, but not at 23. You see how the offer at 23 looks pretty solid, even when volume's hitting it. We traded up through 23 and 23.5 on only like 200 contracts, and I'd be like, oh my gosh, this is just gonna like shoot out here. But there's probably gonna be decent amount of liquidity. You're gonna have to trade 3,000 contracts or more to get above 23. They're giving me the chance to get my 10 ticks again. Well, not quite, but it's close. Now, again, it's come all the way back up here, and that's good, but not really accompanied by volume. Johnny 5S, good morning. Good morning. You know, we've had a couple of new guys today, so feeling it's pretty good. Well, you know, it's that time of year, I guess. Are all of the Pelosi ETF? Oh, I don't know about that. There was a Pelosi ETF, wasn't there? I really kind of questioned that whole idea that, like, by the time you find out, can you really still make money from it? Like, I would be okay with, you know, senators trading if the reporting was immediate. As soon as they put the orders in, we all know about it. It'd be a different game, right? That's what I like about Treasuries. Most gives us a couple of chances before slap. Yeah. I don't know, like, sometimes it just feels so efficient, you know? It's like, I feel like I'm always fighting. I'm always fighting for the right spot. And that kind of gets a little exhausting after a while. I'm a little frustrated because the day after FOMC, I kind of thought that today would maybe be a $20, $30 day, and I'm struggling to get 10. After having a really good move too. That's the thing that was a really good move. Well, I just saw a little bit of buying there in the micro, and they just got buried. Like, there was some buying at 3,746, and then all of a sudden the treasuries ticked up. Am I just imagining things? Like, that is like the third time I've seen now where, like, I don't really see anybody doing anything in the micros, and so I'm waiting. And then, like, when I actually do see a relatively big order go off and everything, the 10-year treasury immediately reverses. Like, I can't imagine that they would have any incentive to reverse the 10-year treasury 4 ticks to be able to take off 30 contracts in the micros. But, like, there's got to be something more going into it. Like, maybe that volume there is happening because of movement on broker tech or something like that. So I was wrong about the Tesla. Well, again, this still looks like liquidity hole through this whole area. Like, you're not seeing huge icebergs show up in here, not until you get to like 23. And you're not seeing huge imbalances in market orders coming through. You look at the cumulative delta, it has been pretty much sideways for the last 30 minutes. Have you? No, I wish. But you know what? We went into this, and I kind of like went on this big, long odyssey. Let's call it an odyssey. The odyssey to find broker tech data. And like, I went and I contacted a bunch of different brokers and all of these sorts of things. And there was no cheap way to get it. because my thinking was, hey, I could totally create a market making robot that would arbitrage between that would use the broker tech prices to arbitrage on the micro treasury yield futures. And I just couldn't get the broker tech data at all. And like maybe there was a way to get it like from them directly, but it's insanely expensive. Right? So shared your link on Discord. Says Horace. Did you like send it to me in a message request? I don't see it. Well, I still don't think I'm getting very many good signs. Like, I think that what I'm seeing right now, yeah, I think that you could get it through TT. That's probably correct. But the whole thing is like, the cost has to get low enough, right? I kind of wonder, hey, if I worked for a bank, you know, and they would certainly have the data already anyways, and would they let me set something up to do it on micros, you know, for funsies? I wish. Yeah. So it's going between 22 and 25 pretty easily. So lower resting liquidity at 22 right there at the moment. See? Not even able to put more than 200 contracts up on either side. They're still kind of treating that 23 as like the ceiling, and they're not really going for it. If we see another meta order long, I think that it would start to come in the next 15 minutes. And I would say that some of the action that I've seen up here has been encouraging, but it's still not giving me more than the 10 ticks. Right? Like, I had a few opportunities to take it to 10, but it's too tight. I think this time I should have had an order there to begin with, and if I really like it when it comes up there, I can cancel it, but I kind of need the spot in line, I think. See them coming all the way down to the other side of the range now so easily. Hardly any, like 31 contracts, 21 half. Like, really? Right? So all this movement that you're seeing, like all price action traders, they'd all get all excited, like this is a higher low and all these things. No, it's market maker noise. Market maker intentionally injects range into that noise into that range. Make more money that way. Just before Nasrallah's speech, IDF began extensive wave of attacks in Lebanon. Yes, so I saw stuff last night that basically suggested that Israel was beginning operations in Lebanon. Do you think that that's something that, you know, like live headlines could affect the markets? Well, if it did, I think that it would probably be a positive for longs in the treasuries. So the 50 basis point hike was already priced in before. So I think that to say it's priced in is a little bit of a flawed model for how the market works, right? There is something to people will take positions in anticipation of something happening, and then when that something happens, there's no reason to be in it anymore, and so they sell off their positions. And so that can kind of create these bizarre counter moves where like the thing happens and it doesn't do what you're anticipating. But there's a lot of other factors involved, and really what we have to look at is we have to say, what are the things that are driving buys right now, and what are the things that are causing sells right now, and kind of factor all of them together. Sometimes you're looking for a particular event but the amount of like volume that is actually driven by that event isn't that much. Oh, did it fill my order? I wasn't paying attention. Well, I think I can be okay with that. I think I might have wanted to cancel it, but it doesn't look like they're coming out quite yet. They are hitting into some volume at 22 halves, so that is encouraging me. Anyways, a lot of the time I will see things where it's like, you know, everybody's kind of holding back because that big event, but then the big event doesn't actually create that much volume. And then there's something else afterwards that creates volume that ends up being more important, and it's something like incredibly innocuous and trivial, like rebalancing and stuff like that. So that's why I say it, like, the market doesn't price things in. It tries to price things in, but it's just the orders. Orders determine what it's going to go, and if you want to predict where it's going to go, you have to predict the orders. Okay? They try to say, oh, it's too low, and so I'm going to buy, but that's orders. Okay? So when we look at this situation, well, this one was really complicated because we've never had a situation where the analyst expectations was for 25 and the market pricing was for 50. But that kind of, if you want to keep that order there for the news, oh, that's a good point. I don't think that one's going to be a huge mover for the treasuries, though. So I'm hearing the number. Existing home sales change, negative 2.5 versus an expected negative 1.27. So that's probably a boost for us. Like, so now 23 is bid, like, that's good. I would have been okay. I would have been okay holding that position through that news. I would only be up 2 more ticks from it. But I don't know if I really intended to take, like, I put the limit order there. I said, you know, I want to at least have the spot in line in case it's close again. But I wanted to pay attention to it closer than I did, and I might have wanted to cancel the order. So, like, I don't know if I can say that, like, I really made a mistake there or not yet, but you know, I'm still kind of thinking more possible uptrend. Well, part of the reason I'm saying that is because we're at 23 half now, right? That's not necessarily like the end of the month. But I do think if I had been paying attention better, I would still be in. Anyways, so because of all of that, we kind of ended up in this weird situation where, like, I wouldn't say that it was priced in. It was like the knee-jerk reaction was going to be, if it's 50 basis points, the market's going to buy up super hard, and if it's 25 basis points, the market's going to sell off really hard. And that is what you saw, at least the knee-jerk reaction. Now, you had the knee-jerk reaction, kind of came back to break even, because I think part of it was that, like, the dot plot and some of those other things were also factors, right? And then there was Jerome Powell's press conference, and he was very hawkish and people sold because of that. So I don't think that where we're at today and the selling that we've seen today and the other action is because it was priced in, and so buy the rumor, sell the news, and now it's going to be down from there. No, I think that it's just a matter of you have to look at all of the flows, and different flows come in at different times, and there's a lot of different things that are involved. And sometimes it doesn't come out the way that you would expect it to. And this is all just a big explanation to say that the market is not very informationally efficient. So there's there is maybe a theoretical price of like what should the interest rate be based on everything that we know about Federal Reserve policy and everything else like that. But the market is almost never going to be at that price. And the issue is if you're constantly looking at everything through the lens of there's a correct value somewhere, and is it already priced in, you're not going to learn the really useful things about the market. Because the really useful things about the market just come from what actually drives orders in that moment. Okay, there we go. See, I shouldn't have gotten out of that. I was hoping to get back in at 7.4, but they didn't come back, so. That would have made my day there, because then it would be 20, right? But that rise was still kind of on, well, the 30-year kind of drove it. So yield curve's not changing, though. So I'm a little bit worried about that. In other words, I'm not seeing signs of like second leg of meta order yet. You think that at least, no, I mean, so like think of it this way. Like, what is the mechanism in which they quote unquote price it in? You know, like you could say, okay, I think that based on my estimate that the market should, you know, range around this particular price, right? And then, you know, if it gets too low, you buy it there. And if it gets too high, you would sell it there, whatnot, right? Well, but the issue again is orders have a very, very strong impact. And so you get down there. Hold on a second. Okay. Oh, the big Jigsaw beta is out now. We should check that out in a second. The issue is going to be if somebody has to sell, they're going to sell into that liquidity and it's going to push it. Right? And you have to realize that the biggest guys, like especially in today's market, like think about stocks. You know what the biggest driver for stocks is? Index funds. So whether they buy or sell is 100% how many people took distributions that month and how many people made contributions that month. And that determines whether they have to buy or sell. And probably the next biggest one would be risk parity funds, which are, you know, based on their contributions and withdrawals, but then also how much equity is made that month and how much treasury is made that month. They have to rebalance their portfolio to maintain that 60-40 equity bonds split, right? And so they're going to buy and sell based off of that. And then the next one after that, and this one maybe in some cases is bigger than either of these, is companies buying back their own shares. And they can do that with debt even, frankly, right? So there you go. Is like you set this range or whatever the deal is, right? But then, you know, it shouldn't go above this. But then guess what? The companies are buying back their own stocks. And that has absolutely nothing to do. That doesn't factor in anything about like what current price, what valuation, how, you know, how high stocks are relative to some other measure or anything else like that. It's just, there's orders, they're going to take out the liquidity and they're going to move the price. And these guys are huge. These guys are huge. So when they do that stuff, it really, really moves some markets. You got to understand, like markets are very inelastic. Oh, hold on. My phone is connecting to, oh, that's kind of weird. Where's my Bluetooth? Good song. my wife is leaving in the car right now, and she's taking the car, so my phone connected to the car started playing, and that's why we lost our music. And it started playing Cosmic Gate. Oops, play on here, this computer. There we go. Happens, it does. Happens to us once a week, because that's like once a week when my wife works. Okay, you know what? That's interesting. So they are back to my 3.74. I don't like it. I think I'm probably done for the day. I guess I made $10 and... Okay, inelastic. What do we mean by inelastic? So, elasticity is a term that is used in economics all over the place to kind of describe how a market will respond to changes in price. So, for instance, there is supply elasticity. So if price goes up, then producers have an incentive to make more of that commodity, and that will tend to make the price come back down. So it's like here you have the current price, and we move away from the current price too quickly, we kind of get pulled back. And that's elasticity. So everybody assumes, well, markets have a lot of elasticity because like you go too far and it snaps back, and they come, they will move really far and then come back to the current price all the time. So that means that it's elastic, right? But more recent research has shown that the markets are actually inelastic. So what would inelastic be? Well, inelastic is kind of like, again, you got price, think of it like a rubber band between my fingers. If you have an inelastic rubber band, then when I move my fingers, that rubber band just stretches, and then kind of like the slack is there. Now the rubber band is just wide like that, right? That's inelastic market. And so like basically what happens, so come back and look at it on the DOM, and let me try to explain the behavior that you get, right? We have a move. There's all of this liquidity on this side and liquidity on this side. You have a really strong move up quickly, right? Okay. So we've just taken out a bunch of sell side liquidity, right? Now at all of these prices behind me, there hasn't been a whole lot of time for those bids to build up. So it's easier to slip back through that area. This whole area kind of becomes like a liquidity hole that you can kind of get sucked back into, right? So what tends to happen is, the orders, it has a really, really strong impact at first, and then like those holes kind of start to form, and it actually kind of hurts price, and they get stuck, right? And then the market makers, they'll back off. Or sorry, the people that are like buying or moving up, the people that are buying, they will back off. They'll back off, they'll start executing more slowly, and the market will fall into that liquidity hole, and you get this sort of a thing, okay? And this is usually 2.5 times this, okay? Time-wise, but typically this tends to be 30 to 45 minutes. And then they'll do it again, okay? But so again, it's like that rubber band. It's like it comes back a little bit, but then it just stays there. So like you would think, okay, if value is down here, we just had this big move up because these guys, they had to buy it for rebalancing purposes. It should go back down, right? It should go back down to what the fundamental price is. But that's not what we find happens. If it moves up, it will just stay there until somebody else comes along and sells it. So again, this is where kind of these models of like what is a correct valuation break down, because you could come in and say, here's a line and here's this and this, but like if we come up here and then somebody needs to buy, it's going to do this and you're screwed. And then it's going to stay there. Then you're going to go, oh, it's got to come back. But there's no reason for it to come back. In order for it to come back, somebody has to sell it. Now, what you will see happen, and this is kind of where it kind of screws us all up, and I think where it was hard for people to figure it out for so long, is that it'll do this, and then like when that kind of pullback starts to happen, if somebody trades it the other way, it's going to go back through that range. And so then you get this. And then you actually end up net lower because of the liquidity, although this formed right here, right? So this is what I call the inverse sine line. It's kind of a secret I'm not supposed to tell you about. When they push back. So if you are like a hedge fund and you're really trying to put like make a real play and a risky play, that's kind of what you do, is you wait for somebody else to execute and like create a hole like that and then push back the other way and shove it. Really shove it this way, and then it moves further. And then all of a sudden everybody goes, oh wait, what's going on? And then that maybe causes other people to think maybe I should sell it too. That's what happens. Okay, what is the 5x? Okay, this is hard to explain. This is where you could kind of start to get into some math, okay? So the market tends to follow a square root law. So I think that it's I equals y, which is a scalar, times omega, times the square root of q over v. I have it on the chalkboard behind me, but you can't see it. So where y is a scalar unique to that instrument, and kind of this is the component that factors all of the unique things about that instrument. Like Bitcoin moves further and has more volatility than the treasury. What are all of the things that, and they've actually done a lot of research about like what makes y. But typically what you do is you collect all of these other variables and then you solve for y. And then you use that in the future to make predictions. Okay. So y is that scalar. Omega is the volatility. Q is the size, as the amount of volume that you're buying, and V is the total amount of volume during that time. Okay. So this has a square root, which does weird things, because square roots do weird things when they're amounts less than 1, right? So let's say, let me change it to my pen here. Let's say that we're going to do 0.01 of V. So we're going to be responsible for 1% of the volume during that period. That's Q, right? So we're just going to be Y omega times the square root of 0.01 V over V, right? So we're substituting 0.01 V in for the Q. Well, those V's cancel out. And then what do you get? The square root of 0.01. So who remembers 6th grade math? What's the square root of 0.01? Well, it's 0.1. It's 0.1. So do you see what I just did there? 1% of the volume ends up being 10% of the volatility. Isn't that crazy? Let me say it again. 1% of the volume can be responsible for 10% of the volatility. That's how big of an impact volume has. Now you see why markets do what they do, right? It's chaos. It's everybody has such a strong impact that it's, they're canceling each other out and everything. So that's why it's not like so wild and confusing that you can't completely understand what's going on. But like, if somebody comes in and buys, it's going to go up. And if somebody comes in and sells, it's going to go down. And those impacts are really strong. And then when you get these big guys that have to trade it over the whole day, and they have to do it in multiple legs, yeah, it moves really far. And this is why the market is naturally chaotic and inefficient and all of these other things. Yeah, 1% of the volume can be responsible for 1% of the volatility. Is there a name for that equation? So I've never been able to find a good keyword that you can like search for to find that. But the way that I would go about it is find the studies. So the study that I would search for is a million meta order in Bitcoin market. Let me show you. Let me search for it. Million meta order Bitcoin. A million meta order analysis of market impact on the Bitcoin market. And then when I come in here and I click on the PDF. Oh, no, that's not a good example. Archive. Archive has it. Okay, view PDF. Scroll down here. Oh, look, there it is right there. Right at the very beginning. Right? I of Q. The impact of a meta order size Q is equal to size or Y times the volatility times the size of the meta order over the volume. And then there's this thing, but it's that's basically always 2. That's basically always 2. Or sorry, not 2. It's always 1/2. 1/2. Because the square root of Q is equal to Q to the 1/2, right? Okay. So, what does that look like? It looks like this. That picture I was showing you earlier, right? At first, it looks linear. Think, oh, I'm having a really strong impact. And then, like, as you put more orders, you're getting less and less out of them until, like, the market just can't move anymore and it gets stuck. So it's the square root law. Okay? And then when you stop executing, it will fall back into that hole. And this is what we call the post-meta order mean reversion period. This right here. Okay? This thing right here follows a 3/5 law. So it's basically something like, I think it's like Y omega times the square root of Q over B to the 3/5. Except for that it's like some percentage of this. Okay. And so, because it's a 3/5 law, basically, like when you do the math and everything else like that, that's 3/5. So the other component of it is 2/5. Ends up being 5/2, which is equal to 2.5, right? So that's where I get the 2.5 from. That's I'm not going into all the math because I'd have to go back and look up a few equations, but it comes from the 3/5 because it comes from 2.5, and so the 2.5 basically means the amount of time that it takes for the liquidity to completely recover tends to be about 2.5 times the duration of the original meta order. But to simplify it even further, tends to be 20 to 45 minutes in the 10-year treasury. So like what happens is you go and you take a trade. You're looking for some meta order long, right? And you get in and then we're just going sideways. So what does that mean? That means I must have gotten in during the post meta order mean reversion period. So what do? Wait 20 to 45 minutes. Wait 20 to 45 minutes, and maybe if there's another leg, you will get this. So now what you do is you say, I have 20 to 45 minutes to understand what where kind of the edges of this hole that has been left behind by the previous action is, and try and get a good position on the lower end of it. Right? Part of why I've been having a problem today is that like they just keep ramping it, right? Like, so we got 375 to 374, and then we wanted to get back in at 374, maybe, or maybe 3745. That would be even better, right? But it's the best it's been giving us is like 3.738. So it's not pulling back as much, and it's being frustrating. Okay. But that's the thing is like, so people will come in and they'll take a trade and like it doesn't go, and then they'll stop out, and then they'll take it again and it doesn't go, and they'll do that. And you'll go through and you've taken like 5 trades and it's just doing this the whole time. And you're like, what the F? How do you solve that problem? Take a trade and it didn't work. Wait at least 20 minutes. Wait at least 20 minutes. Then there's a possibility that you're in a new meta order and you can actually get a move. Da, 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 da. So that's what it means. You can also kind of do this math about like if it moved this far back, then it's going to come back 3/5 and whatnot. So you basically do this into 5 and it's going to come back to this one, right? Which actually corresponds relatively okay to like 50% between 30 and 50% pullback. So that's probably why some people seem to think that they see stuff in the price action and everything with Fibonacci numbers and everything. But again, the problem is that like somebody can come in and trade it anytime and it will move. So looking for a pattern doesn't really matter. It's kind of curious, isn't it? If I go and I look for a pattern in the market, you're not going to find it. Action in the short term is very, very random. But there are things where if you do something, you can predict what it will do to the market very, very precisely and effectively. So, and that's kind of where the empirical stuff goes. Right. When you're looking at empirical data, the empirical data is not when there's a head and shoulders, it tends to go down X% of the time and all, because they found that those things tend not to work and change, and that there's a couple of like data snooping biases and so forth in those. But instead what they do is they say, if I do this, well, how will the market react? They can do that. Wow, they came all the way down to the 373. That's so fast. Wow. That was not even like 2 minutes, was it? Well, should I have tried to get back in? Maybe I should have. Nah, it's good info. It's easy to get stopped out repeatedly and have to choose between that and holding on patiently. Well, yes, because really, if you're going to day trade, I kind of feel like that there's 2 ways to do it. One way to do it is just take these teeny tiny little wins as it's going back and forth there. That's really hard to pull off in the treasury because like this thing is actually just the difference of 2 ticks. So like if you don't have a good spot in the line, you like don't get filled. And those don't work. Or if you do get filled, it's actually coming against you. So it's either that or know which way the trend is going and get in and hold it for all it's worth. Right? So what did I do? How did I screw up? I got in here and I got filled, I think here. And I said, oh, I didn't mean to do that. It came back. I was maybe going to get back in and I didn't see enough of a one, but then it went. That was a mistake. I put the order. I meant to cancel it before it got filled. But I stopped paying attention. Otherwise, I'd still be in and I would have made twice as much, right? Because why? Because somebody's buying and like, here's another leg, right? It's going to take them a long time. And it's basically like you come in here and you say, oh, okay, at 7:15, 7:30, let's say 7:30, at 7:30, they're buying, right? So then chances are at 8:15, they'll be buying too. That is the autocorrelation in order flow sign. Is the primary thing that I'm trying to take advantage of. It's not momentum. I have to watch the order flow to be able to see it. Well, with all that said, we are at another key line here, 26. And there's one of them suspicious bids. So especially with a 10K order right there. If I had been in that trade still, I definitely would be taking it off at 3.73. That does not mean that there's not going to be another leg and it's going to continue to take them up to the open, and maybe even all the way up to 115 even would be kind of an interesting spot for them to test as well. It's just that when I start to see that much volume trade at a spot and I see the spoofs that look, it's gone now, that is usually a good sign that that leg is done and they're going to start digging that hole. And, you know, if I'm not going to be around for another hour, I probably should take my profit there. And that's where I'd get out. Octavia says it was still a good trade. I think so. In that situation, it was really hard for me to know, like, is this really just kind of like a little tiny pullback? Or is it going to like really full on reverse? But knowing what the flows were, and actually that's kind of more of a like not knowing what the flows were, right? Because we came in and we said, well, this says that there's probably going to be a lot of activity today, but maybe not necessarily like a super clear volume imbalance. That's how I was able to say, well, you know, with as much selling as we had, there's probably going to be a pushback move. And then it was just kind of lucky that it went as far as it did. So Octavia says it was still a good trade. I think so too. I think I made a mistake. I really did want the $20, but there was a case to be made to have gotten out early when I did as well. You know, it did pull back and like go practically nowhere for 30 minutes. So that means that exit actually wasn't terrible. Unfortunately, I took 2 bad trades yesterday, so I'm still down on the week, but it's okay. Yeah, knowing a reason why things are happening. Exactly. That's also why I always get into this thing that like the market makers intentionally inject randomness. Basically, the stuff that the retail traders are typically looking at is not going to tell you anything, because it actually truly is random. And then that gets me into the new subject that we've been obsessed about, because we've been reading this book, Making Sense of Chaos: Better Economics for a Better World by J. Doyne Farmer. And in this book, he goes into the science of complexity science. And essentially, he shows how a lot of the systems at the heart of our society, particularly markets, are naturally chaotic. And in fact, they don't work if there's not chaos. So you have to embrace the chaos. You have to embrace the inefficiency. And that is a very interesting, like, I think you can really start to wax philosophical about that when you start to say, actually, because again, people are lazy. People don't want to go, like we were talking about earlier, they don't want to go and do all of the research. Here's everything that's going on that might cause participants to buy or sell today, and then add them all up and say, is there an imbalance? And that's a lot of work. It's a lot of work to go and do the same kind of research that the journalists are doing to find the truth or falseness of a thing. By looking at the empirical data yourself instead of just trying to take somebody else's word for it. We're lazy. We don't want things to be constantly changing, and we don't want things to be difficult to understand and predict. We want things to just kind of like settle and, come to some sort of a balance. And what we did as a human race is we projected that laziness onto the market and said, well, we want things to be balanced and easy. And so that's what you should do is you should be finding some equilibrium and stay in that equilibrium unless something happens and pushes you out of it. But the reality is that the universe is chaos. We think of like, I think personally, this is like one of my most controversial opinions. People think of Christian God as a God of order, and I don't think that that's true. Like God is all knowing in that he can know everything that there is to know. Like he can tell you where a particular quantum particle is at any given point because like he can observe it too. But that does not mean that God is all causing. He is not all causing. There is randomness. There is randomness everywhere. And God is able to deal with the randomness. That's what I think. Have you made an indicator for the square root? Yes and no. So there's not really an indicator, but what you do is this, is you come in and you say, let's see if we can do this. There's, what is it? Fibonacci retracements, I think it is. And you say it went down and it came back, right? And then you change this. Oh, actually, it's not retracements. It's drawing tools. Fibonacci time extensions. Come in and you say, we move from here to here. And then you change this. Levels, 7 price levels. No. Move all of them. Add 2. Add one that's value is 250%. Not 350, 250. 250. 1 price level. Oh, and we want another one to be at 100%. 100%. Okay, there you go. So, didn't really work on that one probably because of the news. But look at that. Okay. Here was the original meta order, and we kind of topped off right there. Right? There's where it from the bottom to the top, and then we take 2.5 times that, and oh look. That's right when it took off again. So if you were going to write an indicator for it, that's how I would do it. And then you just come into this thing right here and go back into the properties, say template, save as default. Is making sense of chaos a good? Yeah, so far there hasn't been math in it like that, so it's been something that you can hear. I mean, it's technical, and he's talking about studies and everything, but most of the book is him describing studies with words and not getting into the math. What's the market order imbalance on that chart? It's basically, it's a rolling measure of in the last, what do I have it set to? In the last 30 minutes, what is the balance in terms of percentage between the market buyers and the market sellers? So how do you use that? And it's one of those, it's a new indicator that is in the indicator suite, if you have the indicator suite from speculatorssept.com. So what this essentially says, if we draw a line here at 50%, right? When it's at 50%, like back here, that means that the market buys and the market sells are equal. And what it's saying right now is over the past 30 minutes, there's been about, 60% market buy orders and 40% market sell orders. So really, to be technical, it is number of market buy orders divided by total volume for the time period. What book? Oh, this book, Making Sense of Chaos. This is a brand new book by Doyne Farmer. Doyne Farmer is like one of the, well, like his thing is complexity economics, But in studying complexity economics, they have found some of these things like the square root law and so forth. And essentially what it's about is, normally in a traditional economic model, you go and you say, okay, there's some sort of equilibrium price, and then there's this thing that works this way, and you write up an equation for it. And sometimes that can be really complicated. Like, you know, how do what you have like a utility function, and then the people have to determine what's the thing that has the most utility for them to determine when they're going to buy or sell something, and like that's too complicated for any person to calculate on their own. So how are they actually doing it? So what these guys do instead is they create a computer model that says, okay, here's we're going to simulate every household in America, and we're going to give those households these really simple rules about how they behave. Like, one of the models that they talked about that I thought was super, super interesting was they said, okay, each of these households is going to get a certain amount of income a month, and then they're going to determine how much of that income they are going to spend and how much of that income they are going to save. And the way that they're going to determine how much they're going to save is they're going to look at the neighbor that has the most stuff, has the most toys, and is the richest in the neighborhood, and ask them how much are they saving with a little bit of randomness, right? And then they play that out. They have all of those computer agents act and do stuff, and you have like a time interval. You say, okay, everybody's going to do and make their decision. Like, we're going to go day by day, and they're going to like change their decision every 15 days or something like that, right? And they see the way that it plays out. And in that particular study, what did they find? Well, if you go in and you tell them this is the optimal savings rate, everybody just do that optimum savings rate to like make the most money, but still be putting enough money out into the economy so that the economy keeps going. If you do that, the economy actually stagnates. So when you actually kind of have a thing that is like reasonable to like how often people change their decisions like that and everything else, then you get regimes, and you get something that kind of moves chaotically back and forth between recessions and boom cycles, just like the real economy. And so by just giving them a few simple rules that I explained all of the rules to you right then and there, they're able to duplicate these extremely intricate, you know, economic cycle things that we see in real markets. And that's what the book is about, essentially. So what it's really about more broadly, though, is, hey, economists aren't very good at making predictions, are they? Why is that? Well, there's this deficiency in our models, and this is a way to kind of address that deficiency that can actually make very, very good predictions in some instances. And so we are on the precipice of a new stage of economic discovery based on these agent models. Super cool. But again, the thing that comes out of it, though, is that it creates chaos. That these models are chaotic, and that, like, if you don't have the chaos, everybody just does the optimal thing, like, the economy doesn't actually work. So you have to have the chaos. That's huge. That's huge, because that contradicts everything that everybody wants to believe about the economy. Is that, like, everybody wants to believe nothing bad should ever happen, and if it does, it was the Federal Reserve or the president's fault, right? That's kind of what libertarians tell you. It's like, we need to leave the markets alone, and if we left the markets alone, then everything would be hunky-dory all the time. Or people on the left. That's the other thing. It's like, well, once we get enough regulatory structures in place and the Federal Reserve becomes good enough at its job, market volatility will go away and recessions will go away, and it just will never happen again. No. Why? Chaos is an essential necessary part of the market for the market to function and for the market to thrive. Without the chaos, things atrophy and die. So I'm still kind of feeling FOMO-y about not getting in again, but I guess it's kind of just been in this range for a while now, and we're getting close to our time, so it was good for me to not try and get involved again. Have some Audible credits. Yeah, I think that'd be something you could listen to. I'm about 2/3 of the way through it now. So I'll probably finish that this weekend. And then I think the next book that I want to pick up is like How to Be a Manager or something like that. I need to find a good book for that. And I know that there's got to be something in there that's like a book that like has made like game-changing revelations in how effective management should work and everything. I don't know what it is. So I need to do some research for that tomorrow, I guess. They're touching 27 now. They may, if they were to get 30 ticks before I go, then I'd really be miffed. Because that was, I gave up 2/3 of the move. Yeah. Well, how could I have known that the meta order would be this huge? A 40k change. 40k change, that's pretty extreme. But I guess about what we should expect on a day like this. So yeah, I really, even though it was a good trade and there's a lot of things to be happy about it, I did screw up by putting that limit order out there and then not paying attention to it enough and canceling it when the flow was starting to look good again. Oh boy. Here's a thread on Reddit that is pertinent to my interests. Technical T9369 says, I can't find a profitable strategy. I have tried to backtest thousands of scalping strategies. However, whenever I enter a trade, it almost always moves in the opposite direction. I've watched hundreds of videos, but I still can't find a strategy that is even close to profitable. To be honest, I started trading with only indicators years ago, but I realized that this approach wasn't leading to success. Since then, I've shifted away from relying solely on indicators. For instance, I've tried trading with support and resistance, supply and demand, ICT, silver bullet strategies, etc., but I cannot get even remotely profitable. Does anyone have tips? Okay, this is r/street trading. So the reality is that markets are extremely chaotic on an intraday basis, and past prices are just not very effective at all at predicting future movements. So pretty much all of the technical analysis that you'll find out there, no, let's not say it that way. If you do find a technical edge, the market can arbitrage it away very quickly. So you're never going to find a public strategy that works like that. That works for long. Let's put it that way. So, if you're going to trade intraday, you really get two choices. Either one, be a robot. Either be a robot, or know enough about the market to be able to predict what people are going to do. Look for informational inefficiencies where you can know things about future orders that the rest of the market. Which means spending more time reading about reports and how various institutional strategies. I thought management textbooks were on point. Okay. I've heard these guys say like manager people. Like I remember this one guy that was a really good manager for me, and he was saying like there was this book that he read, and it completely shifted what his attitude on management was. I keep getting responses to this thread on Reddit, and it's really weird to me because it's like I got 500 upvotes, but almost every comment is kind of like almost aggressively contradicting me. So I said something that resonates with people overall, but the leftists really hate it. So it's really curious to me that this continues to go, and that like even 3 days later, I still get comments about it and stuff. It's weird. There you go. There's the 30. I'm really disappointed in that still. You know what? Part of the reason why I wasn't paying attention though was because I was giving you guys really good information, right? Probably gave you too much information. Like those of you that first time this is streaming here, you know, assuming that you're not really going to sit here and learn order flow with us every day and really want to know what's going on, you could leave and feel like you understand the market better than most people and be satisfied with that. Never watch again. But I thought that was I'm sharing you information that we share all the time on this stream, but I thought that was a pretty good run through. A particularly good run through of it. So, where do you think this is going to stop? Do you think that it will get to 115 even and above? Because that would be like a $50 trade. No, I didn't really expect it to go that far back. Actually, so here's another thing. Was that, you know, I see a really big move down and I think it's going to come back. Let's delete that, by the way. I tend to want it to come back to these levels. These levels are like it's an agent-based model. It basically says like, what is the average cost for a market maker right now? Like, where's their average position at? And if the market's going to rebalance, kind of needs to get back to that spot, and then the market makers can like unwind the inventory that they have. So like that's a good spot for a pullback. And you can see how it responded to it until it broke out. And then even since it's broke out, they're only just barely riding the buyer's cost basis. So the original plan was, in fact, get in here and get out here. It's just that this move looks so good in cumulative delta that I really wanted to hold out to see if there was another leg. And it did end up happening and I missed it. So that's unfortunate, but... I thought management test points better content than whatever A-lister authors are putting on their fundamentals like Theory X, Theory Y approaches for different types of organizations. For example, undergrad professors should follow Theory X, where it's more instructional. Postgrad professors would be more Theory Y, which is more controversial. Okay. Well, I just want to pick up a book because I'm not looking to become a business major per se. But to take a book and like take a first read at it and dip my toes into this and see what I learn. See if I find it useful or not. That's why it kind of needs to be a book that like should provide really groundbreaking insights into it that most people don't pick up on. And I'm sure that those books are out there because I've heard people talk about them, but I don't know what they are. Okay, there's my bell. That means it's time for me to go, guys. But I will be back tomorrow, and I think that we might still have some good action tomorrow as well. And we did make a little bit of money today, so it's okay. But in the meantime, stay excellent.